So you think you're ready to start investing. So what types of things do you need to think about? How do you actually start investing? Check out our video. This is 5 ways you can start investing now. So the first thing that I want to talk about when it comes to starting to invest, especially if you haven't already done so, and when I'm saying invest, I'm meaning specifically into the market. There's a couple things you want to consider before you actually pull the trigger. And these are kind of standard. These are things that I typically recommend to clients. Obviously, every client's a little bit different, but these are some big things to think about. First thing is, kind of before you even think about investing, what types of debt do you already have? So there are what are called good debts and bad debts. Probably many of you know a bad debt is credit cards. So do you have a lot of high interest credit card debt that you need to be thinking about? Not that you can't invest if you have some debt, but certainly if a lot of money is tied up in debt that you have, that's something that you'll want to consider and divert some funds to be paying that down, because the interest rate and the amount you're paying in interest is going to be more than you would make in the market over a period of time. So it just makes sense to be paying down that debt. Another important thing to think about is, do you have savings? Do you have emergency savings? Do you have some cash, stacked somewhere that you can, not physically, but in a bank account and a savings account, checking account, bank account? Do you have that somewhere that you can access if something were to come up? The thing that I see that's not good is, you start investing and let's say you put all the cash that you have into some type of retirement account or stock bond account, and then your car breaks down. You have no cash or no ability to fix that. So you put it on a credit card or some other form of debt, and you're kind of back down that rabbit hole. So it's really important that you have at least 3 to 6 months of required expenses in a bank account. So make sure that is in place as well. And the third thing to think about is, what excess income do you have? It's worth sitting down, maybe using one of the wonderful, there's a ton of different types of software out there to track your cash flow or to track your budget. But what are you bringing in terms of income, and what are you spending, and what excess is there? Because it's really important that you're able to sustain your lifestyle and build in a way of investing. And if you are spending more than you're making, or there's just not a lot of excess, it may be worth exploring some ways you can save, some areas you can cut back on spending, especially because investing should, typically in most people's situations, should be a priority. And so it's worth sitting down and thinking about. Those are things to think about before you actually start investing. So let's say you've done those things and now it's like, what do I do? Where do I start? How do I put money away? The first thing I'll say, and this is one of the more common, easier ways to start investing, is if you're employed by an employer, not self-employed, you have somebody that you work for, start with that. See what type of benefits they offer. Certainly if you're in a large company, they're very likely going to offer a 401k. If you're working for a state or local government, 457, and a nonprofit, usually a 403b, or school 403b. Start with your employer. Whatever type of retirement plan they have, you can start taking advantage of that. Usually you also have HR resources that are there to tell you a little bit about the plan and how it works, and what you can know about it. I'm not going to get into the details of those plans today, but it is important to see if you have one and how you can be partaking in that activity. Another reason I like to start with this one is often employers will match up to a certain amount. So it kind of used to be a standard. A lot of companies would do 3%, so 3% of your compensation if you contribute 3%, and then a certain portion above that. Companies are always vying to get really great talent, and so I've seen everything from kind of the 3% and then 50% of up to 5%, so then a total of 4% match. I've also seen just 100% match up to 7%. So make sure you talk to your HR person or look through your benefits information and understand what the match is. And at very least, if you're able to get the max you can to get that's free money on the table. You do need to stay at your company for a period of time, so make sure you look at the vesting schedule. But again, if you're going to be there for a bit of time, and at least some of it will likely be yours. So at least take advantage of those things. The second way you can start investing, let's say you're kind of already taking advantage of your employer plan, you can start your own individual retirement account. So most of us have some type of vision or dream of retirement. I'm not going to say what that means. It could be working part-time, it could be transitioning into a different lifestyle. So I'm not going to define that here, but a lot of us do think at a certain age, usually kind of older in age, that we won't be working as much. Again, every person is a different situation, but this is kind of a good starting point for that traditional type of person that does see at some point to stop working. There are what are called Roth IRAs and IRAs that you can look into as a viable option to invest in. And these can be found. There are so many different, we'll call them custodians, companies that offer this for a very low cost. Of course, I would recommend working with a financial advisor that can help you figure out where and how to get that managed. But I'm sure many of you have heard of Betterment. There are these kind of tech startup firms that are starting to get into that space where you don't have to have a lot of money to put away, and you can contribute to those retirement accounts. There are some retirement plans that you can take advantage of if you're self-employed that allow for more of a contribution. So for IRAs, $6,000 is the max this year. For employers, you can put more away with other types of vehicles like Simples or solo Ks. So we'll get into that today. But as an individual, you can contribute to a Roth or a regular IRA. Make sure you know the rules on what, there are different rules for if you make certain amounts of income, you can't contribute to a Roth. So make sure you understand the rules. Again, a tax professional or a financial planner is going to be really helpful to help you help implement this. Even if it's a few dollars a month, put something away, and it'll be working for you and compounding and becoming a valuable asset for you in the future. Third way, and not everybody has this, but I am finding more and more companies have what are called high deductible healthcare plans, meaning that it's usually a lower cost for you. If you're a healthy person, you'll usually do kind of this high deductible plan, and it'll be a lower cost in terms of premium, so you're paying less out of pocket every paycheck. But you have what's called a deductible that's really, really high. I mention that just to make sure that if you have one of those plans, you'll typically also have an option to contribute to an HSA, health savings account. This is kind of one that I don't think a lot of people think of. It's usually provided by your employer, again, depending on your employer if they offer it. But if they do, it's a really nice vehicle. You can put money away into it, but people don't realize that after you get to a certain threshold, usually it's about $1,000, after you're over that $1,000 mark, you can usually invest the rest of those dollars. You usually need a little bit in cash in case you need to use this account for health expenditures. The rest of that can be put into the market. It can be invested based on your risk, based on when, your time horizon, when you think you might need access to those dollars. It's one that I see all the time where clients have their money in cash sitting in an HSA and they just keep contributing, but they don't use it. Make sure that money is working for you. So again, talk to your HR person, see how you can get those dollars invested. Your HSA does follow you. So if you leave your employer, again, you have to be, under a high deductible healthcare plan to continue to contribute to it. But you retain that on your own and you can continue to contribute as long as you qualify for it. So definitely something to think about. Next one is a brokerage account, or what people sometimes call like a stock or bond account. This is what's called a taxable account. So usually I kind of start with looking at retirement planning and putting some money in for retirement. But again, depending on your goals and objectives, and if you're already kind of maxing out or putting money into those retirement vehicles, a brokerage account or a taxable account can be really attractive because what it does is it allows you to pull money out of it before your age, 59 and a half. Those IRAs I mentioned before, you have to be 59 and a half years old or have some type of exception qualifying event to take money from that without being penalized with an excess tax. Really important to note that brokerage account can be really attractive whenever you need money before 59 and a half. Keep in mind, if it's invested in the market, that doesn't mean it's liquid, it's not cash. So not saying you're going to get a certain amount out of it, but as a long-term investing vehicle, it can be great to put some excess dollars in and see what happens and save for that house in 10 years or 15 years or that dream house in 30 years. And usually you can open these similar places that I just mentioned. There's large custodians that, like Betterment or TD Ameritrade, Fidelity, Charles Schwab. These custodians, usually you can go out on your own and set that up. I would certainly recommend a financial professional to help you, but that they're very accessible and they're very low cost now. And there's no max of what you put in each year. So put in as much as you'd like, but you will be taxed on any of the dividends, or if you're, selling any positions in that portfolio, you'll be taxed capital gains. So it's important to understand the tax implications of that account. And lastly, this is a little bit less common. It's more common for those people that I work with that are on the West Coast, or people that are on the kind of working for tech startups. There's kind of an emergence of increasing stock options with different companies. There are so many types of stock plans, and what that means is different. So I'm not going to get into the details, save that for another video. But my point is, there may be the option to participate, whether it be buying your company's stock at a discount. You may actually be granted your company stock, just depends on what your benefits are. This is a form of investing. Of course, it's a concentrated position. So, you're investing in your company, and that is just your company, which means it's not diversified. So I would say work with a financial planner to figure out the right timing of how much of it you should have and when you should diversify. But it is something to consider. So again, starting with that employer, what can you take advantage of and learn about from your current situation, from your current employer, and be able to leverage that to start investing. So thanks so much for listening. I'm Maddie with Minerva Wealth Planning. Please let us know what you want to hear. If you like what you're seeing, please subscribe. Or like our video. We're always trying to put out great content, so would love feedback. I'm always open to feedback. But thanks so much. Hopefully this was helpful.